Hey, welcome back to Three Clowns. Alex here with Tom and Ray. It's episode 23, May 6th. We've got AMD absolutely crushing it on earnings, while oil is getting hammered on peace talk whispers, and somehow gold is rallying in the same sentence, which is the kind of morning that makes you wonder what the hell is actually being priced.
Morning. That's already too many contradictions for 4 a.m.
Morning, guys. Tom, I am right there with you. My brain is currently about 60% static. Yesterday, I actually tried to unlock my front door with my car fob for a solid minute. So if the numbers are acting up, I'm definitely in the right headspace to sympathize.
Yesterday, I spent 10 minutes microwaving something that was already cold, and then ate it before it got hot. I don't know what the plan was there. Just a very confusing relationship with time.
Tom, that's incredible efficiency. Why let thermodynamics get in the way of a meal? Honestly, I think between my car fob and your cold food, we're basically becoming ghosts that just happen to know things about the yield curve. It's a weird way to live, man, but at least we're doing it together.
Iran talks moving forward, futures green. The S&P up 0.6, the Nasdaq up 1.1, and oil's down 7.7% pre-market because that risk premium is just unwinding across the board. But here's the thing. Gold's up 3.3% at the same time stocks are rallying, which almost never happens together. And meanwhile, the SEC's moving to kill quarterly reporting, shippers are mapping out Hormuz bypass routes, and global oil reserves are actually plunging at record pace, even as prices fall. So the buffer's thinning while we're celebrating lower costs. AMD crushed it. Revenue up 38%, data center up 57%, stocks up 18% pre-market. And that's dragging Apple and Google higher while Nvidia recovers. There's also a Canadian gold miner halted after a project block, Uzbekistan pulling off a London IPO that's got the frontier market crowd paying attention, hedge funds loading up on inflation hedges, private credit scooping distressed debt at 65 cents on the dollar. Friday's NFP, retail sales, UMich sentiment, biggest data day of May. So we've got three threads. 1. Does AMD's CapEx actually earn its cost, or are we just in a bond funding cycle on the AI railroad? 2. Is this Iran de-escalation trade real, or a morning trade that evaporates by lunch? 3. And maybe the real question, gold and stocks both up means what exactly is the market hedging right now?
Yeah, AMD kind of ruins a very tidy bearish narrative this morning. 57% data center growth isn't vibes. That's hyperscalers actually writing checks and then coming back for more. And the guide stepping up into next quarter. That's the part people gloss over. That means it's not just a one-quarter pull forward. The orders are still there. And tying it to this morning, oil collapsing while AI rips, we've basically swapped the constraint. It used to be energy scarcity caps growth. Now the market's betting compute abundance drives growth, and energy just gets out of the way. That's a big bet. Not a crazy one, just very total.
Tom, that energy for compute swap is a wild way to frame it. But the gold move is what's really making my head spin this morning. Think about the causal chain. Normally, if oil drops nearly 8% on a peace headline, you'd expect gold to dump right alongside it, because the geopolitical panic is over. But gold is up 3.3% while the 10-year yield is softening. That tells me this isn't a safety trade, it's a Fed permission trade. If oil collapses, that's a massive disinflationary gift to Jerome Powell. Like someone just reached into the basement and pulled out the biggest bucket of kerosene before it could catch. So the market is whispering that the Fed might finally have cover to ease. But did you guys see the banks? The financials ETF was basically a flatline yesterday, while the rest of the market was throwing a party. The equity guys are popping champagne, but the credit markets are still looking at that yield curve and saying, I'm not so sure the fire is out yet.
All right, let's go tape it all down. See which of these moves actually holds, and which ones are just the market talking to itself. So oil's down another 7.7% this morning on Trump saying the Iran talks are moving. And what's wild is that the energy stocks barely budged yesterday, even as crude was already collapsing, which tells you something very specific about what the market actually thinks is happening here.
Energy equities didn't move because they don't believe the barrels are actually coming back. This smells like headline supply, not physical supply. If the energy ETF stays flat again today while crude's down 8, the market's basically saying nice press release, call me when a tanker shows up.
It's that disinflationary mirage. Lower oil gives the Fed cover to pivot, but with global reserves plunging at a record pace, we're basically trading long-term energy security for a temporary dip in the CPI. If those Iran talks hit a snag, we've got no buffer left to catch us. And that's when the second wave of inflation actually gets teeth.
So here's what's interesting. Small caps are up again pre-market. Russell 2000 at plus 1.18, and it's not just risk is back on. It's three very specific things. Oil's down 7.7, which kills input costs for domestically focused industrials and materials. The SEC just moved to scrap quarterly reporting, which is a direct regulatory tailwind for smaller companies that don't have the compliance infrastructure of the mega caps. And shippers have already mapped out Hormuz bypass routes, which quietly do worst-case oil shock scenario for industrials before the open. But here's the thing that doesn't fit. Financials are basically a flatline yesterday, up 0.02%, which means the banks aren't confirming this rally. Tom, that's usually the canary in the coal mine. What do you make of the fact that cyclicals are popping, but the sector that should be screaming on lower rates and a risk on tape is just sitting there?
It's not the 10-year, it's the stuff sitting behind it. Loan growth soft, charge-offs are ticking up, and the curve's still basically flat. There's no margin expansion to get excited about. Banks don't buy vibes. They're underwriting a borrower who looks fine until the refinancing hits at higher rates. Equity markets pricing a soft landing. Banks are pricing the part where someone misses a payment.
So gold's up 3.3% pre-market while stocks are also rallying, which is the first time in weeks we've seen both moving together, and that shouldn't happen if the Iran news is actually de-risking geopolitical premium. What you're watching is the market deciding this isn't fear went away, sell the hedge, it's oil's down, rates are staying lower longer, and there's not enough physical metal to go around. And that last part just got a concrete reminder. A Canadian gold miner halted trading after regulators blocked a project, which is a supply-side signal that above-ground gold supply isn't getting easier. Ray, from your macro lens, is this the market hedging against the second wave you just mentioned, or is the gold bid just structural now regardless of what stocks do?
See, the Bloomberg headline says it's steady on the ceasefire, but a 3% jump while stocks are green is the market screaming that it's found a loophole. If oil stays down, the Fed gets the cover they've been begging for to finally soften their stance, and gold is just front-running the 10-year yield sliding off that 4.42 level. It's not a war hedge anymore. It's a Powell's going to blink hedge. But man, if those payrolls on Friday show even a hint of wage pressure, this entire permission trade is going to get absolutely incinerated.
I think Ray's got the mechanism right, but I'm more skeptical of the confidence in it. Gold's up 3.3%, and we haven't even seen the labor print yet. That's not really a Powell-blink hedge. That's a bet that he has to blink. And if Friday's data is hot, we just torch that entire trade. So yeah, oil down gives political cover for cuts, but the market's front-running the permission before the permission exists. That feels fragile. Okay, so AMD just put up a data center number that honestly leaves no room for debate, 5.8 billion, up 57% year over year. That's not a beat, that's a rout. And watch what's happening in the pre-market right now. Nvidia actually reversed and is up 1.7, Google's still holding at plus 1.8, but Apple just flipped negative, down 0.5%. Tom, AMD's Q2 guide is 10.9 to 11.5 versus 10.5 consensus. Is that telling you hyperscaler capex is actually accelerating? Or is AMD just eating someone else's lunch?
It's not the print, it's the guide. 10.9 to 11.5 against 10.5 consensus. Orders are still showing up. That's not a one-quarter pull forward. Apple flipping red while Nvidia goes green again. That's not broadening. That's the market remembering Nvidia has GPU contracts. Google holding is the one to watch. If that sticks into the open, software's finally following semis.
And speaking of capital chasing new angles, Uzbekistan just went live with an IPO in London, which is exactly the kind of emerging market story that shows up when global investors are hunting anything that isn't dollar denominated. Ray, walk us through the footnotes. There's a lot more under the tape today.
Thanks, Alex. Well, looking at these footnotes is like going into the basement of a house that's just been painted. It looks great upstairs. The futures are green. Everybody's happy about these Iran talk headlines, but the foundation is cracked. While the market is pricing in this de-escalation, the actual physical reality is that global oil reserves are plunging at a record pace. We're burning through the buffer while everyone is betting on a handshake that hasn't even happened yet. See, the reason that matters is that if these talks stall, and let's be honest, they usually do it first, we aren't just back to where we started. We're in a room with no exits because the physical supply cushion is gone. It's like driving a car on fumes because you're pretty sure there's a gas station 5 miles ahead. If that station is closed, you're just stranded. And speaking of stranded, look at these Hormuz bypass routes the shippers are talking about. People think, oh, just go around. These workarounds are incredibly expensive, and they don't have the capacity to handle the real volume. It's a headline fix, not a structural one. It adds days to the journey and thousands to the fuel bill, which, guess what? That flows right back into the inflation numbers we're all pretending are solved. Even the smart money knows it. Did you see that Regal hedge fund in Sydney? Their inflows for inflation hedges are jumping. The big allocators are rearming. They aren't buying the inflation is over narrative because they can see the basement is flooding while we're arguing about the wallpaper upstairs. Tom, what are you seeing on the credit side? Because that private credit move, buying debt at 65 cents, that feels like the same story, just a different floor of the building.
Buying at 65 isn't a trade. It's a fire alarm. Someone on the other side needed cash, not a better price. And the quit profit part? Either they got very lucky on timing, or that paper was never actually 65 to begin with.
Tom, that private credit thing is the perfect lead-in to this SEC move to scrap quarterly reporting, because we're basically voting for more darkness. The market is cheering it because it saves smaller companies some compliance cash. But what we're actually doing is deleting the smoke detector. If you only see the books every 6 months, you aren't seeing a trend, you're seeing a result after it's already baked in. It creates this massive information asymmetry where the big players can feel the vibrations, but the average investor doesn't find out the engine is smoking until the whole car is on the side of the road. And speaking of things getting harder to track, did you guys see that Canadian gold miner getting halted? The government just blocked their project. People keep asking why gold is sitting up near the highs even when the dollar is strong, and it's because the supply side is hitting a brick wall. Regulators are making it almost impossible to bring new supply online. You can't just print more gold when the permits don't exist. And that's a structural flaw that the macro tourists usually miss. It all leads to Friday. We've got the jobs report, retail sales, UMISH, the whole kitchen sink. The market has spent this entire week building what I call a permission narrative for the Fed. They want to believe that because oil cooled off and Iran isn't escalating, the Fed is finally free to cut. The 10-year is already at 4.42 this morning. If that yield starts creeping up before the sun is even up in New York, we're in for a wild one. But if those payrolls print hot on Friday and wages are still sticky, then that whole permission slip gets shredded in real time. The Fed can't ignore a hot labor market just because the S&P is in a good mood. Alex, how fragile does this tape actually look if NFP surprises to the upside?
So the oil trade is already bleeding out. Futures up, but the oil ETF, down 7.7, says the market's already pricing deflation. If NFP surprises hot, you lose the Fed cover story and gold tanks. But AMD's backstop is real. Hyperscalers don't care about rate cuts. They care about inference. So the fragility is all in the narrative, the permission structure, not an actual capital flow. Which means Friday doesn't kill the tape. It just kills the excuse for why tech keeps going.
Spot on, Alex. The market's been leaning on this permission narrative like a crutch, and it's starting to look a little flimsy. It really hit me how concentrated Friday is. You've got the non-farm payrolls, retail sales, and the Michigan sentiment data all landing in the same window. It's an unusually heavy pileup, and if any of those three numbers miss the wrong way, the whole soft landing story just loses its structural integrity because there's no margin for error left. Tom, take us deeper on this AMD story. I know you've been itching to explain that railroad bond connection.
Yeah, so the railroad thing isn't cute history. It's basically the cleanest template we have for important technology. Catastrophic equity returns. In the 1870s, you had real demand, real usage, and still too much track got laid because capital was cheap, and everyone assumed they'd be the line that mattered. So you end up with functioning infrastructure that just doesn't earn its cost of capital. Now fast forward $700 billion this year, maybe $1 trillion next, and AMD comes out basically saying orders are accelerating quarter to quarter, which means the buyers, the hyperscalers, aren't blinking, they're contracting forward and pulling supply through the system. That's the brait from railroads. This isn't retail speculation, it's concentrated buyers with balance sheets. But then Moody's drops the $500 billion in off-balance sheet leases. And you realize the leverage didn't disappear. It just moved into a quieter drawer. Same economic reality, nicer accounting. So the whole game is, are we building ahead of monetization or just building ahead of visibility? Because those look identical, right up until the cash flows don't show up. Alex, do you think the hyperscalers actually have line of sight to ROI here, or are they just in a prisoner's dilemma where nobody can afford to slow down first?
Yeah, it's both. And that's what's terrifying. If it was pure delusion, someone would eventually blink. But AMD's guidance shows the demand is real. The CapEx arms race is real. Nobody's hallucinating. The prisoner's dilemma is just nobody can afford to be first to realize it doesn't matter who has the most GPUs if nobody can monetize them at scale. Every railroad owner thought they'd be the survivor. The hyperscalers are thinking the same thing. So the question isn't whether the CapEx is justified, it's who actually captures margin on the other side of it. And right now, that answer is genuinely unclear.
That's the thing, though. The railroad analogy always misses that those guys owned the actual geography. You couldn't just manifest a second track on the same plot of dirt from Chicago to New York. But these hyperscalers are all buying the same silicon to run the same models. The moat isn't the physical iron anymore, it's just the network effects of the customers on top, which is why AMD wins the tax regardless of who actually figures out how to make money.
Yeah, that's the whole thing. AMD's guide reads like actual demand showing up, not people daydreaming about workloads that might exist in 2030. The railroad analogy scares people, but the mechanism's different. Back then you went bust because the other guy ran the same track cheaper, and you both had debt breathing down your neck. Here you go bust if nobody's willing to pay per seat, per inference, per anything. Because the use case never earns its keep. That's a much weirder failure mode, because pricing pressure you can model. Demand that never materializes is just absence. We haven't mapped that yet. Let's go to calls. We've got Friday to predict.
Scoreboard time. Tom called the Nasdaq red below 670 yesterday. It closed 681. Wrong. Ray called the oil ETF above 149, closed 144. Also wrong. I called the 10-year below 40.45, closed 442. Wrong again. 0 for 3. The reverse signal is officially cranked up to 11. Somebody in this room is about to accidentally print money by being catastrophically wrong. Let's find out who. My call, The Russell ETF. The Russell closes up less than 0.5% by today's close. All this pre-market green is concentrated in mega cap and semiconductor. Small caps are the canary in the coal mine, and I don't think they hold this. They'll fade. I'm wrong if the Russell ETF holds above a full percent into the afternoon and just keeps climbing. Tom, you're up.
AMD opens at 420 and does the thing these always do. It closes below 400 by the bell. Because you've got three cross currents that don't like each other, real earnings. Yes, but oil down nearly 8% is screaming demand fear. Gold ripping is a hedge bid, and the 10-year only drifting lower isn't confirming some clean risk on. So the fast money sells the gap, and the slower money waits for a price that isn't heroic. I'm wrong if it holds 410 through midday and never really dips, then the buyers actually mean it.
So Tom's calling the gap fill. AMD gives back the earnings pop before the close. Ray?
Look, 2 and 15. At some point, the law of averages has to kick in, right? Or maybe I'm just the ultimate contrarian signal for our listeners at this point. But looking at that 7% collapse in oil, that's a massive gift to the Fed because it drains the inflation pressure right out of the room. It's like the market suddenly realized the higher for longer boogeyman doesn't have a leg to stand on when energy is cratering, and that has to drag the cost of long-term borrowing down with it. So I'm following that move into the bond market. The 10-year yield finishes the day below 4.38%. I'm wrong if we get any surprise headlines today that make the Fed sound scared of the labor market again before we even get to Friday's jobs report. Back to you, Alex.
So here's what's wild about today's calls. We're looking at small caps fading, AMD gapping down, but the Fed potentially getting gift-wrapped cover because oil's in free fall and yields are compressing. It's not a contradiction so much as it's a bifurcation. Growth gets whacked, but the macro setup for looser policy gets better. That's the tension we're watching. That's episode 23. Thanks for staying sharp with us. See you next time.